President Trump's signature bill is currently making its way through the U.S. Senate. And while there are concerns about what it could mean for government spending and debt levels, there's also worries about what it could mean for foreign investors, including Canadians. Joining us now to discuss is Brad Simpson, Chief Wealth Strategist with TD Wealth. Brad, great to have you back on the program.
Greg, it's great to be here.
This is a question that has been percolating since that bill sort of hit the scene. You have a new report actually coming out on the very topic of how these proposed tax changes could impact Canadian investors. The One Big Beautiful Bill Act standing in a bucket. What do we think is from a Canadian perspective?
Yeah, I mean, I'm saying that the articles, like the ink is dripping on it still. So, well, I mean, maybe let's start out with the context, and I think you mentioned it, but I think understanding the context of which this is going to happen is going to help explain an awful lot of things. So, first and foremost is that you know the United States has a deficit and debt problem, and you know so. I think I'd start out, I brought a chart along to give some context of why you would be doing this. So what we're looking at here is there's two things that the United States wants to do. On one hand, it wants to improve its trade deficit and wants to reduce it. And on the other hand, their ever-mounting debts, which and their spending is continuing to increase. So you kind of have these two things that ultimately they would perceive that are adding to a greater and greater debt problem. Now, the issue then is to say, well, how are we going to solve for this? And one thing you want to be able to do is what's incredibly politically unpopular is to raise taxes. And you know that would be kind of maybe an obvious choice, but that's one's not in the cards. So what the solution for that is really different types of tariffs, which is what we're seeing here, and then what we're seeing with inside the One Big Beautiful Bill Act. Is Section 899, which is one that's really got everybody concerned right now. And so if we're looking at that, think about Section 899 is that one of the things that American large tech companies are very upset about is that there is a digital tax in countries like the UK, the European zone, and in Canada. And they very much want to have that taken away. So inside of Section 899, is this piece of legislation that says, okay, for people who are imposing, for foreign nations that are imposing unfair taxes on the United States, in taxes like the digital services taxes, there is going to be proposed, and let's be clear, this is proposed, and we're going to say this in a long ways to go, there is a proposal to have a graduated withholding tax on securities that are held in the United States. Now, for clarity, this is not, the devil's in the detail here on this. And so in our publication, Nicole Ewing, who heads up our wealth planning office, she and I wrote an article that published today. And, I'll give you some of the kind of the highlights from it, but I really highly recommend this because we really kind of go into the detail over and over.
And there's detail here, right? Very fine detail. Yeah.
And I think that's it. And so, the starting point is you've got to look at first and foremost things that would be exempt, would be things that are held in a registered account like an RSP or a RIF and that nature. And so that's where a lot of Canadian investors have an awful lot of their holdings. That's a good thing. Where it is potentially an issue is owning a U.S. security in a non-registered account. And that potentially, not on the capital gain, but on the income, on that there is a potential for withholding tax, which, so if you look at that as it wouldn't be immediate, it would be like a stepped up, it would start at 5%, and then it would go up another 5%, looking out to be able to max that out at 20%. And so that's what's proposed in this. But there's a long ways to go between proposed and where we look and where we are today.
When we think about the proposal, obviously we're hearing on the politics side in the States that the Senate isn't just going to rush it through.
Right.
They seem to have some concerns about it.
Right.
But what do we think the chances are of these changes coming into effect? Or is that just sort of crystal balling?
Yeah, well, I think that's maybe the starting point would have to be is to go that there is a reason why there are three separated areas of U.S. government. So this comes out the House, goes to the Senate, which is where it's gone now, but it doesn't just go to the senators and they vote on it. It's gone to a Senate Finance Committee, and that Senate Finance Committee, of course, is going to have representation from across all the United States. And there's certainly different senators who would be thinking about, this is not good news, and this doesn't meet the needs of my constituents. So this is going to go through all those discussions, all that process that's going to take. And let's say it makes its way through this. The chances that it would have no adjustments or no changes are abysmally low, right? So let's say they make those changes and they go through all that process. Then it goes back to the House again. Then the House is going to have to vote on this whole thing again, and then it's going to come back to the Senate and go from there. So, I think the key to this, on the trying to find the timeline for it, is that often is going on between countries right now is, we are in the middle of a global trade war. And so, you bring out a 1,000-page document that gives you all kinds of different options on how you can negotiate and conduct this ongoing trade war. So I would look at it as to say that clearly in the clearly in the UK, clearly in the EU, and clearly in Canada right now, there are folks who are giving this digital service tax a good hard look, and understanding that we're going to have to look at what revenue are we getting from this?
So is it worth it?
Right. And I think that and so. Crystal balling it, no one knows what the outcome is this going to be. The flip side of this is that if we started to walk down the road of what the potential for this is, so don't know what the outcome is, however, it being as egregious as it looks today, probably quite low. However, I want to put some context on this even more. And I think it's the really important part of this is that twofold, and this is the impact on a portfolio, right? So what's the impact if I own real estate property down in the U.S.? That there's already a withholding tax of 15%. Potentially from there you could have another 20% with a 35% withholding tax. That I think is one that folks are very, very much concerned with. And again, long ways to go for that. Now, in our world, and what I do, where we're allocating to public equities and private markets and bonds, and
I would have changed the way you think about the U.S.
Right. Yeah, and so let's. This is a very different scenario than this one, right? So first and foremost, an awful lot of people hold their investments inside a registered account of some sort. So you kind of got to look at that first. Second one is that. Typically, when we're allocating or people are buying U.S. securities, they're buying U.S. securities for growth. There's a really big difference between Canadian companies and U.S. companies when you're allocating to them. Canadian companies are allocating to them. You're wanting growth, but a lot of your return is you're going after the dividend. The way our economy works, our major companies work, they're far more structured on cash generation and paying out that dividend, whereas in the U.S., look at the last few years here, Mag 7 every 5 minutes, and growth. And if you wanted to get growth, the U.S. is where you're going to get it. There you're looking at a dividend of an average dividend, say, for the S&P 500 at 1.3%. And so once you take a look at that and you make your adjustments, the net impact is actually a lot lower than really is what the headline risk is on this. And so I think because of the nature of how you're looking for your returns in the U.S., this is a smaller issue net compared to other areas of this could impact somebody's net balance sheet. But on the investment side, it ultimately is between account structures and kind of where you're trying to get your returns. We think this could potentially have a lot less, if it even went through as is, that less than what you think.
So we put all of that together. Investors have been asking themselves, should they do anything about that? What should investors be thinking right now?
Yeah, I think the starting point of that one is first and foremost is the most important part of this is how you've actually structured your own personal wealth.
Diversification.
Yeah. Well, no, that's the investment side. The starting point is actually built to sit down, work with your advisor, and work with your advisors and look at where and what sort of accounts do I hold the type investments that I hold, right? Because there's a difference here between registered and non-registered, and what do I own? And so I think that should be your starting point. The second one is also looking at, okay, now that when I own that inside that registered and non-registered accounts, what is the exposure that I have? What is more oriented to growth, which has far less dividends in it? Whereas on the other side is that where am I more focused on dividends and in the income stream? So look at the sort of asset allocation you have and what the nature of the return you're looking at, and so that you have a clear understanding. And then looking at your portfolio as a whole and says, how are we invested and how are we allocated? And yeah, one is for sure, think about diversification is still going to be the bottom line on the investment one. And the whole reason you have different structures that you hold your investments in is in for the potentialities of this. And I think the last one is in the meantime is that we don't know what that outcome's going to go. And even if, let's say it happened, like as is, right up, one goes to this finance committee, they say they love it, goes in, and we know this isn't going to happen, and that goes to the Senate, they go, we love it too. We would still be looking at January 1st, 2026 before this would even come into place, which means with all those different structures and way of looking at how people hold their accounts, that there would be many things that we would be able to do to be able to go, okay, let's look at this and stare this down and how we would structure it once we know. So start, I think the most is expect the worst, right? But or expect the best, but plan for the worst. We can do that. We have lots of runway to be able to do this, and I think if you do that, I think I've read a couple articles about this the last few days where they took out all the detail and made it sound very scary. I think when you start going through the detail, there's an awful lot of things that ultimately investors are going to be able to do to be able to mitigate the risk of this.